Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is February 15th. This will be the last one of the week. I do these Monday through Thursday. Today we are going to take a look at Rollins. This is a pest control service out of the consumer discretionary sector. Let's jump right in the video. And if you are new to the channel, just stopping by, or you just have not done so, go ahead and hit that thumbs up down below. If you find value in the content, go ahead and hit that subscribe button and hit that notification bell so you're notified whenever we put out any new content. Doing that really does help a small YouTube channel like me. So again, hit the thumbs up, hit the subscribe button, join us on this journey to financial freedom. Hopefully you're on your own journey as well. Join the Vested Interest community, and don't forget that notification bell down below as well. And drop a comment. Let me know what you think of the video. Let me know what you think of Rollins. Let's keep going here. This is the Vested Interest stock screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I am interested in investing. And if it's a company already in my portfolio, it is a way to back check to make sure the company still meets the criteria I've set. We're going to run through the videos looking at this criteria right here. So let's continue on. And on to Rollins. If you want to know more about this company, check them out at www.rollins.com. That's www.rollins.com. That is their homepage where I pulled this information from. Rollins Inc is a leading global company that provides pest control services through its subsidiaries and franchises. Through our leading brands such as Orkin and Critter Control, we offer top-notch services to 2.8 million commercial and residential customers in the United States, Canada, Australia, Europe, Asia, Central and South America, the Caribbean, Europe, and the Middle East, as well as Africa. And you can see a lot of the different brands underneath their umbrella. The ones you're probably most familiar with: Orkin, Orkin Canada, Orkin Australia. Another one that I really, Critter Control is one I've seen. These other ones are probably regional, Fox Pest Control, Home Team Pest Defense, True Tech Wildlife Service. I mean, these are all probably regional subsidiaries underneath their overall umbrella. But again, www.rollins.com if you want to know more about this company. And that's what they provide, right? Pest control services, whether they're coming spray for, ants or cockroaches in your house, or whether they're coming out to, take that pesky raccoon away, right, with Fox Pest Control, I think is what they do, in Critter Control. So a little bit of a mixed bag in what they do, but overall, they're dealing with pests. And the reason we are taking a look at them, down 5.74% on the day. We are talking about Rollins Inc, ticker ROL, out of the consumer discretionary sector. Closed out the day at $41.71. 52-week range as low as $32.19, as high as $45.04. They are a tick closer to their 52-week high than their 52-week low. Average volume 1.7 billion. Today's was 4.6. Pretty much a sell-off. There was a bit of a spike midday, well, actually about 9 a.m. But from there, once the market opened, just a sell-off throughout the day. Beta doesn't list the beta. I'm a little surprised by that. So you'd want to do a little bit of research to see how volatile this company is. Price to earnings ratio, extremely high PE on this one. I really don't like how high this is, 50.25. I mean, this is tech company high, right? This should be a technology company that's growing extremely fast. I don't know that they are growing fast enough to justify this, but a 50.25, $50.25 price to earnings ratio is really high. EPS, earnings per share, sitting at 83 cents per share. Pretty low, actually. Earnings date was today, so they must have either missed earnings or their forward outlook is not looking as good as it once did to cause such a sell-off. For dividend yield, they have a low starting dividend yield, 0.6%. 1.60, that's 60 cents. Divide by 4, they are a quarterly payer, I believe. We'll see that here in a little bit. And a 1.36% yield. Very low starting dividend yield. 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from. Not affiliated, just one of the sources I go to. $44.86. So they see it going back up, not quite hitting its 52-week high, and slightly above where it currently sits. Now we're going to get into the statistics, look at dividend yield theory to see if this one is presenting any potential value. To do that, we go down to dividends and splits. We look at their 5-year dividend yield average, 1.02, compare it to its current 1.36. Now this actually speaks to a little bit of undervaluation. If the current yield is higher than the 5-year average, that speaks to undervaluation. If this was under the 5-year average, that would speak to overvaluation. They are inversely correlated. The payout ratio is 62.65%. I look for 75% or less, so this meets that criteria. I would want a bit more of a margin of safety on this, and a bit higher yield. It just has such a low starting dividend yield. I mean, I'd really like it to pull back closer to this $32.29 or $32.19, under $40 at least, if not under 36. I would say really under about $36 for this one for me. And it's such a low dividend yield. I don't even know that I'd be interested at that point unless it's growing extremely fast. We'll see that here in a little bit. Ex-dividend date was February, or is coming up in 5 days on February 20th. You want to buy this February 19th or before if you want the next dividend, and that payout is going to be March 11th. Now we're going to get into the financials. A lot of good information under the financials. You can find their balance sheet, their income statement, their debt to equity ratios, their assets over liabilities. Is their revenue growing? Are their margins expanding or contracting? Are they paying down debt? We're going to look at free cash flow. We want growing free cash flow over time. Typically, if a company has growing free cash flow, the dividends are growing along with it. And they use free cash flow to pay down debt, to make acquisitions, to reinvest back into the company, and pay dividends. And as dividend growth investors, we want dividends and we want them growing. So looking at free cash flow going back to 2020, $412 million. Bit of a drop in 2021 down to $374 million. 2022 back up to $435, and then so far 2023 numbers $469. I would say overall, short of this one outlier in 2021, growing free cash flow, and even then this outlier, you can look at the repurchase of capital stock. They increased their repurchase of capital stock here in 2021, so that could account for some of that. Might have been a flat year overall, even though they did have some repurchase of shares in 2020 as well, and repurchased in 2022. Significant repurchase in 2023 so far. So 2023 looks like it's been a banner year overall. Now, I always recommend more than one source. So another one I like is stockanalysis.com. You pick any sources that you like. Just make sure you're looking at more than one so you can make sure the information you're getting is accurate and up to date. Now, they have 7 stock analysts that have taken a look at this. They call it a strong buy. They have a low estimate of $40. So if it dropped down to their low estimate, that would be a 4.1% decrease from where it currently sits. Their average estimate of $46, if it happened to hit that, that would be a 10.29% increase. And a high estimate of $52, which would be a 24.67% increase in the current stock price. All the while, you could collect that 1+% dividend yield, which is, again, pretty low. Now, statistics here, I like to get in and look at financial efficiency. To do that, we're going to look at return on equity, ROE, and return on invested capital, ROIC. And return on equity, I like 10% or better. They're at 37.64, very good. Return on invested capital at 21.94, beats the 10% I'm looking for. So overall, good numbers here. And we're going to drop and look at earnings per share growth forecasted. I like 5% or better. This is sitting at 13.05, and they have a very low EPS right now. So it's good to see that they expect it to grow by double digits. And revenue growth, 8.93. Now, I'm not sure if that revenue growth at 8.93 justifies the high price to earnings ratio currently, but it is good to see that it is at least growing just below double digits overall. Now let's take a look at, again, quarterly payer. We're going to look at the dividends here. Payout ratio 68.18%. I think it was a little lower on Yahoo Finance. Either way, it's under the 75% I'm looking for, though it is creeping up there. I will say, for such a low payout ratio, to be paying almost 70% of your free cash flow is actually a little concerning to me, because the dividend growth, though it is very high, 21.74%, it doesn't leave them a lot of buffer between that 75% or less I like. So if they continue this dividend growth, unless their revenue is really going to grow like they think it is, or even faster, this payout ratio is going to continue to go up and at some point be an issue. And like I said, usually when I see a company like this, like a Microsoft with such a low payout ratio, or an Apple with a really low payout ratio, their dividend yield is low like this one, but their payout ratio is next to nothing. It might be less than 10%. So when I see a low payout, or when I see a low dividend yield and a low dividend payout, I want a low payout ratio to match that so that they have a long runway to increase it. So this is the only thing that gives me a little bit of pause. For such a low payout, 1.6% dividend yield, or 1.3% dividend yield, their payout ratio is pretty high. But they do have dividend growth at 21.74%. I just don't know how long that is sustainable. Going back to February 2021, they were paying 7 cents and some fractions of a penny. November 2021, they jumped it up to 10 cents. November 2022, they jumped it up to 13 cents. November 2023, they jumped it up to 15 cents. So it's a couple pennies each time they're raising it, you know. So nice dividend growth. Payout ratio a little on the high side for such a low dividend yield, in my opinion. That would be the only thing that gives me a little bit of pause. And I would want this one back in the mid 30s. That's where I would be interested in this. Gives me a bit of a higher dividend yield overall. So let me know what you think of Rollins. It's not really one that is on my watch list. It's not really one that I'm interested in, but I saw the 5% drop. I've heard it discussed on some other channels, so I thought we would cover it on this one. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences. We can't benefit from each other's investing, but we can certainly benefit from the knowledge that we have gained along the way. That is my goal here, to share what I am doing. So hopefully whenever I make mistakes, you can learn from them and you can share your mistakes and we can all learn from them together. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Rollins you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below and I will work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you had a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money, so never invest any amount you're not comfortable losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.